Hello everyone and welcome to our monthly webinar. My name is Justin Cooper and I'm here with Travis Sperr. We're both hard money lenders and full-time real estate investors. Each month we bring in some of our friends in the industry to share their expertise. Now this may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. Now I want to thank you for spending tonight, whenever you're watching this with us. Travis and I know that you're giving up some of your time, so we will do everything we can to bring you the value that you're hoping for. Now, this webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors, and we are investors ourselves, so we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, tonight's webinar is a little bit different because we are interviewing each other, if you will. We're just gonna have a conversation about what Pine Financial has done over the past year, what we see coming in the future for Pine Financial Group, what we've done personally, with our own investing. So with that, Travis, why don't I turn it over to you? Maybe we can start with a quick recap of how Pine Financial did and what we did in 2017.
Very good, cool. And just real quick, since we're recording this ahead of time, we're going to throw it out on YouTube. We really encourage you, if you have any questions or comments, or you want to discuss something further, to please leave comments on the YouTube page below. I guess I'd say like down there. And we'll be happy to answer those. Or feel free to give us a shout at the office. Phone number is 303-835-4445. So real quick, as Justin indicated, give you a recap of what Pine Financial did in 2017. Good year for us, not the most loans that we've ever done in a year, but still a strong year with the limited inventory, which we'll talk more about. We came just short of $55 million in loans between Colorado, Minnesota, and we're actually doing a little bit of stuff in Milwaukee right now, but not really widespread yet. So it was exciting. We were busy. We came just short of our goal was $55 million. We ended up about $160,000 short. So that wasn't fun, but we'll try again next year, I guess. An exciting thing that also happened in 2017 is we rolled out our PFG Fund 3, which is a Reg A offering, which gives us the ability to raise money in a debt position for the type of deals we're funding. So if you've been around Pine Financial for a little bit, you're familiar that all the money that we lend is privately raised from people just like you who put it in a mortgage fund and then turn around and lend it to people just like you. And so we have the opportunity to take money now. Investment opportunities are available in that fund, and we would encourage you to contact us if that's what you're interested in. So in 2017, we also added a couple loan products and changed the pricing a tad bit to try to be a tad bit more competitive in the markets that we're serving. So Justin, why don't you tell us a little bit about that?
Yeah, so we've been seeing the market changing and fluctuating. There's more lenders coming in. Rates are getting cheaper from different lenders. And then there's also just investors who've had a lot of success over the past several years. As the market has done well, so have a lot of investors. So they've been sitting on more cash. So of course, our Pine Financial's flagship loan is our rehab loan, where we want to cover 100% of the deal: purchase, repairs, closing costs, everything. But a lot of investors don't need that leverage in today's market. They're sitting on cash and they're doing fewer deals. So they want to put that cash into deals, save maybe a couple bucks. So what we did was we came up with a new loan. We call it our acquisition loan because we're lending the acquisition only. So we will lend 90% of the purchase price. And that's it. So real quick, we move extremely fast. We can close this in days, maybe even hours if you really need it. But of course, we're always hamstrung by how fast the title companies can move. But we can move extremely fast on that. We're charging 2 points, generally 12, maybe 15% interest. And like I said, we can move very fast. We don't need appraisals, 90% of the purchase price. And it's a great way for investors to get into deals faster, save some money on their financing, and hopefully stay more competitive in the market.
Definitely. This loan's been pretty competitive for us. We'll talk a little bit more as we kind of recap the year of our clients, but that 90% acquisition loan has been very competitive, and a lot of people are moving to that product. In 2017, we also started more focusing a tad bit more on our commercial lending. So we've funded a couple of deals, which we'll talk more about in the recap, but assisted living, some land deals. We're right in the middle of getting ready to finance an industrial park, if you will, a small industrial area a multi-million-dollar loan for a client who got a killer deal on that project. So we'll talk a little bit more about that. But that's been really fun. Some bigger loans, giving us the ability to be pretty competitive in that market, close quickly, and have some flexibility in getting things done. So if you're working on some commercial stuff, we'd love to take a look at what you're working on.
So we've also expanded a little bit more. We opened up a new market. We're now in Grand Junction, Colorado. It's close enough to home to where we can get there if we need to. We can drive. We understand it because it's still Colorado, but we are expanding. Pine Financial is always looking to be growing. So keep your eye out on us. You know, we don't know exactly where 2018 is going to take us yet, but we're always looking to be growing, whether it be through new products like the acquisition loan, new types of investing like commercial, or just new markets. Pine Financial is always looking to be growing. So keep an eye out for us. If we're not lending in your market yet, because I know there's people from all over the country here, keep your eye on us. We're always looking to expand. And
the great thing about Grand Junction this time of year is that the ski resorts are halfway between our office and Grand Junction, so it gives a good opportunity to sneak some time on the slopes.
Absolutely.
Still have the rehab loan, as Justin mentioned previously, our flagship loan, 70% of after repaired value. Doing that loan still pretty frequently in Colorado and very frequently in the Minnesota market. Still strong deals there that make sense for buying, fixing, flipping with that high leverage loan. And people are having a lot of success with it. Also, the new construction product remains strong, still funding new construction both in Denver and in the Twin Cities market, and seeing clients be successful with that. Some challenges with raising construction costs and different things like that, shortage of labor, but if you have the right team, we can see people be very successful in the new construction projects, and those are going well.
Absolutely. So, Travis, what about personally? How was 2017 for you on the personal side?
Yeah, 2017 was fantastic for me. I wrapped up a new construction project that I was working on just south of Sloan's Lake. And for those of you that are maybe not in Denver, don't know the area, just west of Mile High Stadium and just a tad south. Those markets have been really hot over time as people are kind of moving back to the city and living in these more urban type of areas. And so I wrapped up an 8-unit project. It took me about 22 months, start to finish, by the time you get permits, start construction, etc. Did well, pre-sold all the units through construction. And so once we got our certificates of occupancy, lined them up, closed them, and the project went really well. I did really well on it. And so that was exciting. Some of the challenges that we're seeing in the market right now, as I just previously mentioned, is the rising cost of construction. The construction right now is going up at a faster rate than the properties are increasing. So that's been challenging, and working with the right people is important.
Yeah, we've seen margins getting squeezed at every level, whether it be the low-end rental market all the way up to the larger new construction projects. The cost of construction, the cost of materials and labor, everything is going up way faster than the after repair values are. So margins are getting squeezed. People are asking more money for their land because now they realize they're not necessarily selling their house, they're selling the dirt that it's on. So they understand that, so they're charging more for it. Cost of construction is going up, and yes, values are going up, but not quite as fast. And so margins are definitely getting squeezed.
Yeah, and to those points, the lot that I was able to purchase, also in Denver, very close to Mile High Stadium in the neighborhood Jefferson Park. Coop mentioned how the margins are shrinking a little bit, but you know, the experienced investors and savvy investors are not changing the minimum profit that they're willing to make. So although we see all these increasing prices and things along those lines, I don't waver from the minimum profit that I'm willing to make on a project. So might have to change the project a little bit. Maybe it's more units, maybe it's less square footage, different finishes, that type of thing, to fit the market and still do well. So there's still killer deals out there. We'll talk a little bit more about that. But you know, being good at this business is challenging if you haven't been around for a long time. Not to say that it can't be done, but we just have to be very diligent in what we're doing. And Coop, what are you working on right now as 2017 wraps up and we head into 2018 here?
Yeah, before I dive into that, I just want to add on to what you were saying. I think that's a great point about how the savvy investors, the smart investors, the successful investors are holding true to their profit margins. I mean, we talk to new investors, experienced investors all day, every day. The phone does not stop ringing here at Pine Financial. And so I hear a lot of folks who think that now is the time to get started. And, well, I'm not worried about the profit. I just want to get in and do my first deal. I'm okay if I break even. But the thing is if you don't know what you're doing yet, then you don't know all the things that can go wrong. And basically everything that can go wrong will cost you money. So if you go in thinking you're going to break even, basically what you're saying is you're going to lose money. And if that's your first deal, you probably won't be around for a second deal.
Yeah, such a great point. And although we didn't intend to go down this path, it's an interesting one in that a lot of times when an investor is looking to do their first deal, they're more interested in getting the experience than the dollars. And what's so interesting about that is that it's the newer investor that really needs to protect that big margin because of any mistakes that might be made along the way to protect the profit or potentially limit the loss on a deal. And that's why even savvy investors don't move away from the profit, their minimum profit margins, unless there's a specific deal that makes sense for them. I just talked to a gentleman yesterday. He had a deal down in Colorado Springs. It was a thin margin, maybe $25,000 on a $275,000 house, but he said it would literally take him 2 weeks to do the work, put it on the market. You probably resold within 45 days. So if you can make 25 grand in 2 months, you do that 6 times annually, I'm sure that you'd probably eat okay, right? Coop and I enjoy Panda Express, and we can eat well there with that kind of money. So the point is that newer investors need to really protect those margins. It's hard right now to find good contractors. It's hard to find people who show up. It's hard to find people who can do good work. And so if you can't build in those kind of contingencies into your business, it's going to be challenging to be successful.
Yeah, I mean, the client you were talking to has their own crew and has folks that they work with consistently. So when they say it'll take a couple weeks to get the project done, they know that. And on day one, as soon as that client walks out of closing, they're on the site. They got the dumpster being delivered. People are on there doing the work. But other folks are like, yeah, I can knock this project out in the same time frame. But if they don't even have the contractor lined up until after closing, you're already behind the gun, right? Your 2-week project is going to take at least 3, 4, 5 because it'll take you that long just to find the contractor. And if you haven't worked with them, there's a learning curve when it comes to working with these folks, right? Figuring out how they work. Are they going to be, do they overpromise and underdeliver?
Sure.
There's lots of variables.
Definitely. So as true as always in real estate, we're still making our money when we buy. Speaking of which, you're getting ready to buy property.
I am actually. Next week, I'm buying another rental property. So 2017 treated me really well. I didn't get into any big crazy projects like Travis does, although he probably doesn't think it's crazy. It's like his normal right now. But I've just been holding true to building my rental portfolio. The rentals I have were great. I had 0 turnovers, increased rents a little bit. I've been transitioning to working with a property manager, so taking myself out of the management role and putting it on somebody else, and that's been phenomenal so far. No complaints at all. And I went under contract on a property just at the end of last year. I'm set to close next week. It's a townhome, so my first time working with a property that I would own that has an HOA, so big learning curve there. A lot of diligence back and forth because there were some questions around the quality of the HOA and did they have enough reserves, and just a really great learning curve because I learned a lot. But ultimately, it seems like it's going to be a great property. So we're buying it for $200,000. That's our purchase price. It's already rented to Section 8 for $1,896 a month. And we just had the appraisal come back because I'm getting traditional, just conventional financing. I'm going to put 25% down because it already has a tenant in place. It's already a decent enough property. And the appraisal came back at $242,000.
So where'd you find that deal?
I found it on the MLS.
Yeah, so this is what's crazy right now. Just before we came in here to record, I had a conversation with a gal we've done a ton of business with. I have done business with personally. And she was calling because she had just found this townhome that she was looking at buying. It was right on the MLS. It was listed for $200, needed a fair amount of work, but the value was around $260. And her goal would be to keep it as a rental property. It's 4 bedrooms. So Section 8 in that county, I think, would probably be for a 3-bedroom voucher is probably $2,100 a month-ish. And so what's so interesting to me, and the comment I was making to her was that there's still, now this is a secret, don't tell anybody, there's still opportunities in this Denver market, and that townhome purchase price, townhomes and condos, rough around $200,000, especially if you can get 3-bedroom units, because the rents are so strong right now. Although prices have gone through the roof, the rents have also increased very, very rapidly. And so just as Justin mentioned, a deal on the MLS for $200, just appraised for $244. So you're going into the deal with 20% equity before you put any money down, and it rents for $1,900 a month. That's a good deal. When you've done enough deals, you don't have to hit home runs anymore. Doubles and singles and doubles are okay. But this is what's interesting about this deal. As Justin said, he's going to put 25% down. You might be listening and saying, well, that's cute. You have 25% down. Maybe I don't, right? And so what's so interesting about this deal is that it appraised for $244. So as I mentioned, it's already 20% equity. But at Pine Financial, we could come in and finance that thing, either 70% of the $244 which would have you come into the table with maybe 10% down, or we have our 10% down loan where you could be, so for 2 points and 12% in our Denver market, you could buy this property with $20,000 down plus closing costs and immediately have $60,000 in equity on a property that's in a cash flow right out of the gate. So, and then you could buy it with our financing, put limited down, turn around and refinance it with a conventional lender with no title seasoning, and have the ability to refinance it in cash flow from day one. So what's so interesting is in a time where it's so difficult to find deals and there's nothing out there, nobody's making money in real estate, is the sentiment that we often hear. Justin just told you about a deal that he found and he's going to do with good equity in it. I just shared with a deal with you that I finished last year that had that we did really well on.
Yeah, and so Travis sometimes, I think, talks really fast. And this webinar is coming out in January, so there's probably going to be a lot of newer folks who want to get started investing, watching and listening, or even some seasoned folks who are maybe thinking about transitioning into rentals. And Travis just dropped massive knowledge bombs on you. This is it. I mean, it's been rebranded. We've been teaching this strategy for years.
Sure.
I mean, probably close to a decade now, I guess. But certain other websites and stuff are now rebranding this strategy, giving it fancy names, and it's getting out there a little bit more. But you're basically buying it, fixing it maybe a little bit, right, and then refinancing it. And it's such a powerful strategy. We teach classes on this, like 2-hour classes that go into this in depth. So if you're at all interested, put a comment in there. I want more information. Send us an email. I'm Justin@pinefinancialgroup.com, Travis@pinefinancialgroup.com. Call us. Travis already gave the phone number. We'd love to sit down and chat with you. Come to one of those classes. We'll really get into the nuts and bolts on how this works. We've even got a special report we can email folks. So if it's interested to you, how to leverage higher, how to have better cash-on-cash returns when it comes to rentals, give us a call, drop us an email. We're happy to talk to you and work with you on that.
Yeah, and I'm sorry, I get going. I get so excited about this business. I just have such a passion for it, especially the rental piece, that when I get going, I just kind of go because it's so exciting to me. And sometimes it's hard to remember that when you do this every single day and we're rapping with each other across our office, that we're on the same page, and maybe not everyone is. So thanks, Justin, for the reminder.
Well, I mean, let's. So I guess that's about it for me on the personal side. Mostly just focusing on the rental stuff, and it went really well. I had a really solid year. Which basically means I didn't work very hard, but I made a lot of money, which is kind of the goal, right? In owning rentals, right? We want it to be a passive investment. So how about you, Travis? Now, we mentioned you're very passionate about rentals.
Sure.
You hinted at the new construction stuff, but tell us, let's start off with just your rental portfolio. You got a lot of rental properties.
Yeah, so this year, my wife and I bought our, I think it was our 13th door, all single families in the 1-3 unit that we've had. That was our first property. But actually in 2017, we had a goal of getting to a monthly gross rents of $20,000 a month, and in March, we bought a property that put us over that mark, and so that's really exciting. And I'm teaching a class more frequently now. How many rental properties do you need to retire? Well, I'll share my personal profit and loss statement with you to show you how the rental properties are performing. So hitting that $20,000 a month mark was important. Obviously, hopefully still a lot of runway for me in this life and opportunities to get more properties, but that was an important number to us by looking at the expense ratio and things on what that netted us. So that's been really fun. And then, as we've talked about, and we'll talk a little bit more about, is the rents going up. It's been so difficult as a landlord to stay with the current rents. As an example, I've got properties I was buying in 2011 that were renting for $1,250, cash flowing $600 a month gross, and so that was comfortable. And now, fast forward to 2017. $1,900 a month is what these things are renting for. So it's just incredible how strong the rents are. But it's been hard to keep up with those rent increases. A lot of people, it might be challenging to send them $100, $150 rent increase, which is what the market did. So what I'm finding is I'm taking smaller incremental increases, but to keep the tenants there, keep them happy, and because turnover is just where you lose all your money in rental business. I was just having a conversation with a guy yesterday about this exact topic, and that you really don't make your money in rental real estate until year 2. Typically, when you buy the property, you might have to do a little work to it. You might have some cost to get it rented, and maybe some cost to acquire the property. And then in year 2 is kind of where the cash flow is free, or it's easy, right? So important to limit those turnovers, because right now with the cost of everything that Justin was talking about earlier, I mean, a 1,600 square foot house, if you're $8,000 for a turnover, kind of no matter what. Paint, carpet, maybe some miscellaneous stuff, an appliance, something like that. Like, the money goes very quickly. And so that just kills your bottom line. You got a property that rents for $2,000 a month. There's 4 months of rent, boom, gone before you've even considered your cost of financing or any other expenses. So it's been exciting. It's been fun. I really love collecting rent. But it's just about getting more and really focusing on managing those properties better, lowering expenses, and increasing profits. I mean, at the end of the day, what's so interesting about the rent increases is that if you're under rented on a property, for the sake of conversation, you're renting it for $1,500, but the market rent is $1,900. That's $400 a month, so it's just under $5,000 a year. What's so interesting is that it costs you no more in expenses whether you rent it at $1,500 or $1,900, right? So to leave that money on the table, it's not a percentage of that money; it's every last dollar. And so, important to maybe focus on that in your own business if you're out there and you have rental properties. So, what can you do to do a little bit better on these properties?
Yeah, and it's one of those, going back to what you were saying earlier about fix and flippers, holding true to their profit margins. I think it's the very same thing when it comes to rentals. If you buy a good deal today, right, which several years ago may have been at $1,200
Sure.
a month in rent, and you're able to hold this thing and work the plan, and it's a good deal back then, when we're living through great times like we are right now, rents will continue to increase. So that if and when there's a downturn and what that might look like, you're in an even better position. But if that literally happened tomorrow, the next day after you bought that property, you're still in a safe position. There's still enough cash flow that you can build up a little bit of reserves and be ready for that next turnover, whether that be in 3 months, 6 months, or 24 months.
Sure. And just one comment before we move on to what our clients did in 2017 is that what's so interesting about rental property is that we're talking about this from our experience here in the Denver metro market. But it falls true. These are theories. These are our laws, right? That fall true in any market. Rents are going up and inventory is down nationwide. We'll talk a little bit more about that. So I'm confident that in any market that you're in, you can do well in this business, finding a decent deal and getting it rented and maintaining the reserves and different things to set you up to be successful.
Yeah, and I think that kind of leads into something interesting that we've been hearing a ton about here in Denver, is out-of-state investing. So when I look at buying rentals, I'm focusing in the Denver market because I live here and I can drive there. Not that I do, but I can if I want to.
Sure.
And one of the things I'm looking on is make sure that there is cash flow, but I'm not looking for hundreds and thousands of, well, yes, hundreds, but not massive amounts of cash flow, because I feel that the Denver market, and this is my personal opinion, Denver will continue to appreciate over time, and I plan on holding these things for 20, 30, 50 years. So the appreciation, I think, is where I'm going to get wealthy. The cash flow, I want to make sure that this cash flows so that when I do have the $8,000, $15,000, $20,000 turnovers, like unfortunately I've had, I have the cash flow to handle those expensive turnovers, but I'm going to get rich and wealthy through the appreciation.
Absolutely.
So other people may go to a different market where their cash flowing may be the same dollars on the rents, but because they're buying, instead of this $200,000 townhome, they're buying a $20,000 property or $50,000 property. The same cash flow, but they may not have appreciation. So there's different things. I'm getting a loan with the down payment I'm putting. Somebody else may be able to pay cash in these other markets. And by doing that, or even leveraging that, smaller dollars and down payments, that will allow them to buy more properties. So they may have the strategy of buy lots of these smaller, cheaper properties and have massive amounts of cash flow quicker. And that's their road.
Sure.
So there's not anything pro or con, I guess, about that, but it's understanding why somebody might want to go out of state or stay in state, where you're looking at what you want to be doing as an investor.
Yeah, and I have a real similar approach with the rentals, all being here locally, but and I mentioned previously we're doing a very limited amount of lending in the Milwaukee area right now. And what's interesting there is you could buy a property, rehabbed or rehab, and be all in for about $85,000, $90,000 ish. That'll rent for $1,000 a month. So it kind of meets those numbers that you might deem acceptable, and you may have the opportunity, if you didn't have 50 grand to put down like Coop's going to, if you had 25, all of a sudden you could buy a property there and still cash flow. So it's interesting, and the numbers are pretty similar, right? You're getting just under $2,000 a month for a $200,000 property. There you're getting $1,000 a month for a $80,000, $90,000 property. So it can work out pretty well, but you just have to make sure that being out of state is a good fit for you. So let's look at 2017 as far as what our clients did. It's fun to talk about what we've done, but as you mentioned previously, we have the opportunity to see a lot of people's business, $55 million worth of their business. And so it's cool to kind of look back and see what the trends are, what we see people doing, what we've seen people do to be successful in this market. You want to talk a little bit about some of the different stuff that we saw this year?
Yeah, so First off, the rentals are still very strong using that strategy that Travis was mentioning. So you're buying a distressed asset, you're fixing it up, you're buying it with the hard money, you're fixing it up using the hard money to fund the repairs, and then refinancing it and holding it for the long term. There's still some neighborhoods in Minneapolis and St. Paul that are incredibly strong when it comes to this. You can buy it very inexpensively, a little bit of repairs, and massive amounts of rents coming in. So that can be a great strategy there. We're seeing it here in Denver because there are still distressed assets. We worked through all of the foreclosures from the downturn, but there's always going to be some sort of distressed seller. You can buy properties like that. The one I'm buying certainly needs some love. It's not horrible. I mean, I'm still able to qualify for conventional financing, but it needs some love. And you can find these properties and add value, and thus increase the value of the property through doing it. So we still have a lot of folks doing that, really helping those cash-on-cash returns go up. We've got a lot of folks still doing fix and flips, both through the rehab loan, where hopefully we can cover 100% of those costs, and through that acquisition loan. A lot of folks are using that acquisition loan and having a lot of success getting into their deals, because with that acquisition loan, it seems like folks are getting into maybe more quick turn cosmetic deals, not necessarily the larger rehabs that might make more sense for the rehab loan. So we've got a lot of folks doing the cosmetic stuff. We've been funding more condos and townhomes for fix and flips, because folks are still looking for that first-time homebuyer price point, and condos and townhomes, at least in the Denver market, fit that bill really well.
Yeah.
So we've had a lot of success there. It's been fun watching our clients get in there. And what's great about those is you're generally not doing anything exterior, right? It's only from the four walls in. So a lot quicker on the turns, a lot cheaper on the turns. I'm still seeing folks doing pop tops in all of our markets. People buying, a house, and instead of scraping it and tearing it to the ground like you've been doing on some of your projects, they're just popping the top. And this generally allows them to get through the permitting process faster, right? That's one of the things that you've seen. And a lot of our clients have seen who do the new construction is they're getting tied up in the permitting process. It takes longer to put together the plans. It takes longer to get approved. So, if you're keeping 3 or 4 of the walls and just going up, a lot faster turnaround, which saves money, right? The faster you turn a deal, the more profit hopefully there should be.
Definitely. And what's interesting too about the cosmetic stuff, and you mentioned the condos and townhomes, is we've actually funded a handful of deals in some retirement communities for 55 and over. So I guess instead of first-time home buyers, that last-time home buyer. So those deals have been good for people. But when I talk to people who are doing, when I talk to investors who are doing high-volume deals, I'm finding that they're typically more cosmetic deals. They might have a lower profit compared to something else, but they go very quickly. And what's interesting about this is that there was a time there where the big rehabs is where all the money was, the 60, 70, 80, $100,000 rehabs, because there was a time where we really needed to add value, push value to make these things sell. But in a market as tight as we are here in Denver and
actually, in Minnesota.
Yeah, and in Minnesota, but also across the United States, the typical inventory mark is lower than it's been in probably 10 years. So to do something quickly, what we find with low inventory is you can get away with less. Meaning, maybe you don't need tile, you can get away with linoleum or laminate. You may not even need granite countertops. Like, there's things that people are willing to give up now, especially in price points probably under 350 or 400, that previously was a standard, because they're so excited about the ability to buy the house. So now you're doing a quicker rehab, it's costing you less, but you're squeezing probably a very similar profit out on the back end, and it's going faster to get it done. 2 or 3 weeks, a month to do the work, back on the market. If you're priced accurately, you're under contract within a week. Assuming the first contract closes, you're probably closed in 30 days. So you're talking about a total time of 60 or 75 days, start to finish. Again, somebody who has their crews together and that they know what they're doing, and they're a well-oiled machine. They can do really well in that. Another interesting thing, though, that we've funded, I mentioned the commercial stuff. We funded a deal in Minnesota that was retail on the bottom and some apartments on the top. We funded a deal in Minnesota that was a land bridge to get from raw land to bridge into the construction financing for a senior center. And Coop, you worked on a couple of interesting land and assisted living projects.
Yeah, so the land bridge we've done here in Denver as well. Similarly, in this case, they bought an old restaurant with the intention of scraping the restaurant down to the ground, and then they're going to put like a 60 or 70 unit apartment on it.
That's right.
So now we're not funding the construction, but we are funding the land acquisition because they had to move somewhat quickly to buy the land, right, to satisfy the seller and their time frames on that. But they weren't at a point where they're ready for the construction loan. So we jumped in, we're able to help them get through the closing, right? We gave them a loan to get them over the hump, to get their plans approved, to get their construction financing approved, because in this case, what they're building is going to cost $16 million, right? It's a special type of financing for those types of things. And I think they're actually getting HUD financing, which, you know, can be a great deal, but it also takes an extremely long time to get that financing. So we were able to come in, help them out, get the land, and help them bridge that time frame from purchase of the land to the construction financing. We also did one, we've done a couple now of assisted living facilities. So we've done one that was a single family house, and it still is a single family house, I guess, but it was a large house. And what they did is they renovated the house, they widened the hallways, they widened the stairways, they put in added bathrooms into every bedroom, so they're all en suites, all ADA accessible, which means potentially a wheelchair could be rolled into the showers, things like that, you know, community areas to get together for game night and stuff. Ultimately, they're going to have, I think, 12 beds in this house. At least that's the plan. So we were able to come in and help them out and get them the financing, both to acquire the property and to renovate it. So that was something that was really fun and exciting. But they definitely ran into some hardships. A lot of folks in the real estate investing world are talking about assisted living. And what is it, the silver tsunami?
Silver tsunami. I guess people are getting old out there. They need a place to live.
That's what it sounds like. There can be a lot of money, but it's something they have to remember is this is a business, right? Sure. A separate business. You may own the real estate, but the assisted living is a separate business, right? You're looking out for people. There's going to be nurses, maybe 24-hour assistants on site. So there's a lot of moving parts, and the financing looks very different. You know, we may come in and help them out financing the acquisition and renovation, but ultimately you might be trying to finance a business, not a piece of real estate. Right? So understanding that and being prepared for that might be very different. But something else we were able to do was on a larger scale, somebody had already acquired an old motel, and their plan was to renovate this motel into an assisted living facility. So in this case, you're going to have like 45 rooms. Potential double occupancy, all again en suite, because they're taking a motel, which already is basically en suite, right, and converting it into assisted living. So we were able to help them out with funding just the construction because they had already owned the motel. They got a great deal on the land and the building, and so we came in and we gave them a loan to help them get over the hump and renovate this building. So that's that would, in my case, be considered more commercial. Sure. But it's exciting to see, what people are doing and be able to help them out in all these different types of situations.
Yeah, and it's been cool to see different types of deals. For so long, it was the fix and flip, a lot of them in the same neighborhoods and that type of stuff. And then as we transitioned our business to funding a lot more new construction, that was exciting too, and it still is, and we're still seeing some new construction. What's interesting is that as we've talked about time and time again here, is that the value of the houses is going up quickly, and the construction in some cases outpacing that. But what that's allowing in some neighborhoods is for our clients to go in and pay full retail for the house that sits there, to end up scraping it and rebuilding something bigger, nicer, and obviously brand new, and hit a value on the back end that makes sense for them to do that deal. Now, in the multi-unit new construction, like the stuff I'm focusing on now, 5 or more units in our Denver market takes you about 11 months to get permits from the day you start to the day you get your permit. That's a long time, right? Especially I just paid $1.37 million for a piece of land, and I'm in the entitlement process now. That was an interesting deal because they were about halfway through the entitlement before I jumped in, so my time frame should be significantly shorter to permits.
But still, you paid over $1 million for this piece of land, and you can't really do anything with it for what, 6-8 more months until you get the permits and everything approved.
Yeah, someone with a little more hustle or a little less family may have been out there parking cars on Sundays for the Broncos games at $50 a car or something. I don't know. Outside of what I was willing to do, there was probably some real money there, but different when you have young families. So so there's that. But on the single family side, you can get permits much quicker. In fact, in some cases, maybe as fast as 60 days, but typically not more than 120 if you know what you're doing. And so that gives them the ability on a single family house to jump in, get it built, a very nimble crew would probably build a new house in about 5 months. A typical time frame is probably more like 7 or 8, yeah, depending on getting to the finishes in the tough labor market. So now you're in a deal for just under a year, and you could still make. We've seen $200,000 plus profits on these deals, sometimes funded with no money down. So very interesting. Good to see people doing well in these neighborhoods. What's also interesting is that people have caught on, just like in most investing. And so sometimes you drive these neighborhoods and there's new houses on every single block, $1 million plus. So you got to kind of look at yourself in the mirror and ask yourself, is this a neighborhood that makes sense for me? How can I set myself apart from all these other properties? When there's inventory in that arena, can you still continue to get full price? So just some things to consider.
Yeah, and so along that, you mentioned something that builders, the investors who are doing the new builds, can potentially pay full price for a house, right? They could buy a pretty house, pay full price, but because their intention is to take it from this pretty house to this, I don't know where you can get it on camera there, they can pay that full price. So going back to what we're seeing in the markets, there's a lot of competition out there. If you're someone who is trying to do your very first fix and flip, so you got to make sure you have a very cushion of a spread, because there's going to be changes and unknowns, right, that you have to account for. And you may be using hard money, right? Higher, more expensive financing. You can pay X dollars, right? But if you're going up against the same property against a more seasoned investor, maybe someone who pays cash, or maybe someone who is an agent and you're not an agent and they have some savings there, or they're also a contractor where you're not a contractor, right? They have some cost savings, so they can pay more than you can and still have the same profit dollars. So we're seeing that type of competition out there. Because we're both landlords, right? We're looking at those deals in a very different way when we're analyzing the deal. We're not looking at the after repair value and what dollars can we make profit-wise from that. We're looking at what are the rents and what will the cash flow be. And because interest rates are still so low on 30-year conventional loans, potentially we're able to pay more than any fix and flippers, right? Because we have a different profit motive. We have the new construction folks who are going in, and they're not looking at this ARV like you and I and everybody else. They're looking at that ARV because they're going to be doing new construction. So again, very different models that they're looking at. And then I've seen and heard time and time again that we just have owner occupants coming in, because so many of our clients are now trying to just get into the cosmetic flips. Those same properties will qualify potentially for conventional loans because they're not horrible, beat up, distressed properties. They just need some love. So owner occupants who can't afford the new median home price, of $300,000, $400,000, $500,000, but they can afford the $250,000, $300,000 purchase price for this ugly home, right? It's not pretty. They're getting in there and they have no profit that they're looking for.
That's right.
It's their home, and they're going to fix it up as they live.
In fact, in some cases, they're willing to pay more than it's listed for because they don't intend to make a profit in the short term. They really want, like the neighborhood, the schools, they want to live there. They see you raising their family there, and it's always sticks and bricks, even with your family, right?
Sure.
Yeah, right. So that's interesting. It's interesting in a tighter inventory situation. But I posed this question in a class I taught a couple weeks ago, and it's interesting to think about, especially it's interesting if you're seasoned or if you're just getting into the business. When I got into the business in 2008, you could literally go buy any house off of the MLS, fix it up, and turn around and resell it for a profit. The challenge is that you could buy the house tomorrow, no problem. Inventory, there's plenty of it. Take you the time to fix it up, and contractors were a lot easier then because we're in the downturn and they were all hungry and needed work. But when you went on the market, it might have been 60, 90, 120 days before you got a contract, especially after the first-time homebuyer tax credit expired in, was it 2008 and or 9, and things really slowed down. Today, it might take you 60, 90, 120 days to find the property, similar time to rehab it. But once you go on the market, if you're priced correctly, you are under contract immediately. So which is better? I don't know. I mean, there was so much inventory available before. It was easy to buy houses, but it was a little bit more challenging to sell them on the back end. Now it's more difficult to find houses, but it's easier to sell them on the back end. So which is better? I don't know. I mean, I've changed my investing strategy in this market to go after bigger, more profitable deals than previously smaller, fix and flips. But in either market, there's an opportunity to make money, and that's what's fun about real estate. There's just kind of always an opportunity to make money.
Yeah, absolutely. But I think the important key there is to understand that the market is always moving, always changing, right, in so many different dimensions. So as long as you're aware of these things, you're keeping up on it, you're networking, you're coming to all the classes and events that Pine Financial hosts, where we do things with other folks, not just Pine Financial. It's not just hard money. You're getting a really good idea of what's going on in the market, who the players are and how they're adjusting, just like we are in our personal investments. So are the other people we're meeting with, other lenders, with real estate agents. What are they seeing day in and day out? So, and then being flexible yourself. You have to roll the punches and watch how the market changes and then adapt as well, right? Maybe you're holding strong to your profit spread,
right,
but you're understanding that, you know, how do I get that profit spread? What's the time to actually acquire it? All these other moving parts. You're ready to keep up with the ever-changing market.
Yeah, one thing I think would be interesting for us to discuss just quickly is wholesaling, because as a lot of people get started in the business, they are told they should wholesale, or they think that's going to be their first course of action. And what's interesting to me right now in the wholesale world, and all the wholesalers I talk to, is the margins right now on wholesales, and by the margins I mean the wholesale fees, are significantly bigger now than they were 4, 5, 6, 7 years ago. That is purely a function of inventory. And before, if you locked up a wholesale deal, but 3 houses down was a bank-owned property that I can make an offer on, your wholesale price needed to be competitive with the bank-owned a couple doors down. Now that there's nothing for sale, when you have a wholesale deal, you could sell it at a higher loan to value, increase your fee a bit, and make good money on it. So, Justin, everybody should jump into this business with wholesaling, right? Because it doesn't take any money. It's easy. All you have to do is put the property in a contract. There's no risk. Is that what you're saying?
Actually, so I hear that. I wouldn't say I see that. So because there's still the big national gurus out there who are teaching that strategy, potentially because they're charging so much that they're not leaving you with a whole lot of money to invest, and therefore you should start out with wholesaling because you just make a lot of offers, lowball offers, something will hit, you mark it up $5 grand, and you slowly build back those reserves and those types of things. And so that's what a lot of newer investors hear, and that's the strategy they think they can come out with. I'll just make offers on every property at 70 cents on the dollar of whatever they're listing, the list price is, right? I'll offer 70%, 80% of that, and keep my fingers crossed that it goes under contract. But what we're seeing, the actual people who are delivering wholesale deals, who are, you know, blasting out their buyers list and those types of things, they have teams of people. It's not just a one man or one woman show. They have acquisition managers. They have disposition managers. They have marketing budgets. I talked to someone yesterday. They have $1 million marketing budget per year.
Wow.
Yeah.
Wow.
They're sending out, you know, $20,000, $30,000, $50,000 a month. You know, they have to have the training and the education and the constant practice and role play of how do I handle those kitchen conversations, because they're not just making offers on the MLS, they're door knocking, they're going to people's homes and saying, look, unfortunately, you know, it's public record. I know you're falling on hard times. Maybe I can help you out by, you know, buying your property and taking that burden off of you. But having that and understanding that, how to build rapport, all these types of things take time and money and experience. Right. And that's what the successful people are doing. So I think when you see someone selling a wholesale deal and you look at their numbers and they're making $10,000, $15,000, $20,000, right? It's not just because they got a great deal or because they're trying to give you a not great deal. There's a lot that goes into these types of things. That's not just all profit. There's a lot of overhead that goes into those things. But also they're skilled enough to be able to buy those deals that they can deliver to the marketplace, because if it's not a good deal to a fix and flipper is not going to buy a wholesale deal. But negotiate a strong enough deal to where there is that spread. Those are the people that are having success as wholesalers.
Yeah, and what I love about real estate in general is that that's how the big time wholesalers are doing it. People are still new to this business finding wholesale deals, and that might be by hyper focusing on one neighborhood that you understand really well, or spending time in an area that you know the values well, or you know some foreclosures, or maybe it's your own neighborhood or something like that, where you can go knock on the doors and try to find those deals and be the neighborly person rather than the piece of mail that they're getting. Because when somebody's sending 50,000 pieces of mail a month, guess what they're not doing? Knocking on 50,000 doors a month, right? And so sometimes you might have an opportunity just by being the guy who knocked on the door. Now, if you're going to be the guy or gal who's going to get these deals done, I would encourage you to understand what that looks like when you go and talk to them, rather than just watching this video and going knocking on someone's door to see if you can buy it at a discount. It's important not only to know your numbers, but understand what that conversation is going to look like and how you're potentially going to help them, and how you're going to structure that deal so that you can get paid on the deal.
Yeah, absolutely. So my wife and I, and we're passionate about real estate, right? I'm lucky enough to have this be a full-time job where I make some good money and I enjoy getting up and out of bed every day. But even on the weekends, we'll go and we'll walk around and look at open houses. We'll talk to the neighbors. I've got leads on 2 probate deals on my block because I know the people on my block, and we're talking and we're going. We go into estate sales, right? I'm not worried about getting their elliptical that nobody ever used, right? Because I need someplace to hang my laundry. I go in to see, well, why are they having this yard sale? Go to open houses to see what the competition in your neighborhood, right, from your home, what they're doing and what the new trends are in your neighborhood. But talk to the real estate agents, talk to the folks that are also at that open house. If somebody's at an open house, maybe they're looking to move or sell, or maybe the agent is doing marketing, and you can piggyback on top of that. And oh, well, actually, I'm talking to this other person around the corner.
Right.
Maybe it's something you're interested in. So all these things, you don't have to have that $1 million a year budget to wholesale or to find your next deal. But just go out and just talk to people.
That's right.
Just be nice. Show an interest in them.
Definitely. So kind of recapping 2017 in general, a couple of things we wanted to talk about was inventory, price increases, and that type of stuff that I'll leave to Coop. But what's interesting right now is that the conventional lending is loosening. And a lender that we work really closely with, the term that we use is quietly loosening. And the reason I say it that way is because in the last year or so, Fannie Mae started allowing cash out refinances on properties 5 through 10. So if you're a real estate investor and you've had more than 4 or more mortgages for basically as long as we can remember, the last 10 years or so, you couldn't do cash out refinances on those deals. So now they loosen that up. So now you can cash out on properties 5 through 10. So if you're an investor who's owned rental properties since 2002 or 2010 or 2012 or whatever, and you have a good equity position, but maybe you don't have enough cash to do another deal, it might make sense to look at what that a cash out might look like. Also, lines of credit are now more widely available on rental properties, which they hadn't been previously, at some pretty high loan to value. So that could be a good deal to free up some cash as well to potentially do some more deals. I've seen some people use equity in property to use it as a down payment to buy more property. What's interesting is the spreadsheet or the math will always say buy more properties because you have more rent, higher opportunity for appreciation, depreciation on your taxes, etc. But really what you have to measure is that gut feeling of, if you're leveraging other properties to buy more. But if you're in the right market and you're making good decisions, I think it'd be a good time to look at doing that.
Yeah, so personally, on some of my rentals, I was able to get in on a summer special with one of the local banks, and I got HELOCs on my rental properties. And because I've owned them for a little bit of time, and because the market in Denver has been so hot, I was able to pull or have the access to an extra $250,000 in equity from these things. Now, the bank who gave me that, right, is at a certain loan to value based on the value of the day. So I knew that even if I pulled all of it out, in this case, I would be at 80% loan to value, right, total leverage on the property. So I'd have that 20% cushion. But for me, that gut feeling is me sleeping well at night. That's the big check, right? If I wake up at 4 in the morning and my mind is racing, something isn't right. So for me, even though I had access to the 250, for me, I'm never actually going to pull all 250 because I want to make sure I have that cushion in case something comes up, in case there's a costly turnover, for whatever, another opportunity comes up, that I have a little cushion. For me, that gut check is sleeping well at night.
Sure. Also along those lines, rates are still competitive. Coop alluded to it previously. You were going to do a 30-year note on that property. What's your rate on that? Do you remember?
4.62, I think.
4.62. So was that 4 5/8 right now? Rates are still strong. I mean, in the 4s for rental property. That's crazy to me. And they're up from historic lows, maybe a half a point, however many months ago. So really good time for financing. And for 30-year money, it's fixed. The price, the value is not going to, or the interest rate is not going to change for 30 years. The other piece that we're seeing is that rates are rising, and we've seen the Fed raise the rates 3 times last year. Heard on the radio, probably another 3 times in 2018. As you see the economy recovering, this doesn't always affect mortgage rates, but it's interesting to know what your short-term lending costs are, whether you're on an adjustable rate or your credit cards, if you have bank loans, that kind of stuff. I've been more recently using bank financing for my rental properties on 15-year fixed loans, not going to the full 30-year like I did on my first handful of purchases. So that's been interesting. The rates are similar, titled in an entity. So the bank, in a lot of cases, the bank that I work with, they don't require an appraisal on any purchase of like less than 250 as long as you're putting 20% down. So they're pretty, I shouldn't say pretty aggressive, but they're much more aggressive than banks have been previously. So lending is loosening some. Now they're still making good decisions. This is in 2006, and you still have to have credit, income, assets, etc. But if you're a bankable borrower, there's real opportunities to get loans right now on real estate at these historically low rates. As we discussed, rents are up, values are up, so maybe there's still a good opportunity here with a low cost of money. The other piece is the debt to income. Fannie changed debt to income to 50%. 50% debt to income. So that means if you make $5,000 a month, you could finance up to $2,500, assuming no other debt outstanding. It's crazy to me to think that somebody making $60,000 a year could finance a $400,000 house, but it's real. I mean, that's the financing that's available right now. So as long as you're smart with it, you can make some good decisions. You can get that done. Also, in 2018, which I think is going to be huge in our Denver market and also in other markets around the United States, is that the high cost loan limits, what we always knew jumbo loans to be as kids, right, is $417,000. And in 2017, or maybe it was 16, it went up by 6% to the 450s. And then in 2018, it's going to go up another 6%. But Denver's also considered a high cost market, which means that I think it goes up to roughly 530 for the metro area, which means somebody can buy a $550,000 property roughly with 5% down. That's making it easier for younger people, potentially, say millennials, who have high incomes but haven't had the opportunity to save a bunch of money and maybe shorten their career. So here's an opportunity for them to get into these properties. Now you might think, well, why would a young person, making a couple making $100 grand a year need to buy a $400,000 property? Well, because across I-25 they're paying $3,000 a month in rent when they can buy a property for for $2,500 a month or whatever it might be. So very interesting. Keep that in mind in your different markets, because where people may have been capped on price before, this is going to give some markets a pretty big jump and make it even more competitive in those price points. If you could borrow another $100,000 for only $5,000 down, that's huge. So that's something important to know.
Yeah, absolutely. Because we keep hearing, are we in a bubble? When is this going to burst? When are we going to go over the edge and come back down? What does that look like? When is it just unaffordable? Well, what Travis was just saying is now it's going to continue to be affordable. As the prices go up, the affordability is still going to potentially be there, right? Or the access to it is still going to be there, through small down payments. So for me, looking forward, I see things still continue.
Sure.
Inventory still being tight, people still having access and the ability to buy these properties as the prices go up. But you're going to see some transitions because not everybody can afford that 5% on a 550 house, right? So there's going to be some other things. I think condos are starting to come back a little bit, especially in Denver. There's been a lot of regulation around, around condos and thus affecting, condos and are they being built? And a lot of that I think is being sorted out and has been sorted out, and builders are getting more comfortable with it.
Sure.
So I think we're seeing a lot more condos coming soon in Colorado.
Yeah, what's real interesting when we talk about inventory is that if you want to be successful in any market, I think the key to victory is to understand what your median price point is and look at the inventory in that price point, which will probably be very low, and try to operate your business within, say, 10% up or down from that median price point. Of course, depending on the area and that type of stuff, because those are still what you would consider affordable homes for most people. That's the median price. Now, we use the term affordable, and it's we use it somewhat loosely. I mean, it kind of depends. It's relative on your area, right? I mean, if you lived in Denver for more than 10 years, you think the prices are outrageous right now. But if you're moving from a coastal city to Denver, I just had a guy tell me the other day, moved to Chicago. It's like he loves it. It's so much less expensive and all this. So it's really interesting to understand where the prices are relative. So as you look at your market, whether you're in Denver, Minneapolis, anywhere, it doesn't matter. Understand where the most houses are trading and try to be around that number. What's really important in some markets, like we do a lot of business in Colorado Springs, is that the income down there is capped, is a lower income because there's a ton of military in the area. And so their market is like red hot from 0 to, say, roughly 330 or 350. Really slows down after 350, and above 400, it still is a buyer's market. So it's interesting to understand what the economic constraints of your market might be and what that looks like. When you're looking at rental properties, it used to always be a house that was worth 180, 200 or less should cash flow because the rents in that area will make sense. Well, now 180 or 200 may not get you what it used to. So you might be looking less. I personally have been buying townhomes too, just like Justin had mentioned. It's really interesting to buy townhomes because there's still kind of a price play there, kind of competitive more to an apartment than to a single family house. More people feels like looking for a house than a condo or a townhome, because a lot of these things are older. A lot of these products are older, and not always in the hippest neighborhoods. But more of a place where somebody has to live than they want to live on affordability. So it's just some ideas, of how you might be successful in your market this year, and maybe continue to grow your success and continue to make some money as we go into 2018.
Yeah, absolutely. I think there's going to be a lot of opportunity in 2018. Not necessarily more, but if you get out there and you network and you meet people and you find, what works for you, what you're interested in, what gets you motivated, how you will analyze a deal. It's very important because time is of the essence.
For sure.
With the inventory so low, you have to be able to analyze and move quickly. So spend some time getting to know you and who you are and what you're interested in, and focus on that. So whether it is just, knocking on doors in your neighborhood, going to open houses, going to networking events and getting to know all the wholesalers, right? The newer folks who are trying to play the MLS game, as well as the folks who are blasting out 10 deals a week. Get to know everybody you can. Let them know what you're trying to do so that you're constantly in the back of their head, whether your neighbor gets a tip on something or whatever it may be. Always be letting people know. Even if you're a landlord, tell your tenants that you're looking to be buying more properties. Maybe they'll want to move in. Maybe they have friends that want to move in, right? Maybe their friend is losing their house for whatever reason, and maybe you could help, right? Everything. So with these tighter inventory, tell everybody what you do or what you want to do, and you will have success. There will be a lot of success. A lot of people will make a lot of money in 2018, but you have to work for it. Yeah. It's not just going to come to you.
Yeah, and so as we discuss opportunities, and one of a bigger deal that we're getting ready to close here in the beginning of 18 is a commercial, or excuse me, it's an industrial zone product that's rented to big national tenants, and it's in Littleton, Colorado, south side of Denver, and in a inventory for industrial space right now is, I think, less than 1%. So what's so interesting about that is that they're buying this property. The net operating income as it sits is $500,000 a year. So at a 10 cap, that thing should trade at $5 million. Nothing in Denver is trading at a 10 cap right now, so probably closer to a 5 or 6 or something like that. So this is a $7 or $8 million asset that our clients were able to get under contract and will close in a couple weeks for $3.5 million. There's no deals in this market, Justin. It's so interesting that you have to know where you're looking and finding these deals, but they're certainly out there. And I shared earlier on, but if there's something we can help you with, our phone number, 303-835-4445. It'll be below. But send us emails. Send us, if you have a comment, if there's something we talked about that you'd like to talk a little bit more about, give us a shout. This is an open door, an opportunity to connect. And I'll be surprised to see how many people take the time to do that. But if there's something we can help you with in your business, we would love to do so.
Yeah, Travis and I, as well as Kevin and Sean, we are all incredibly accessible. But we can't reach out to you. This is how we're reaching out to you. So reach out to us. Give us a call, shoot us an email. If you're not on our email list, drop us a note and just say, hey, we want to be added to your email list to get our monthly newsletter, to learn about all the different classes and events, the Success Summit we do.
Sure.
We put together amazing opportunities to come and meet us face to face, spend time with us, pick our brain, and all of our super successful friends in our network. Leverage what we're doing here through this video to help you succeed in 2018. We're here to help.
Very cool. You think we covered everything we intended to?
I hope so.
All right. So give us a shout. Let's see how we can help you be successful in 18 and beyond.
Thank you.
Thanks.